Right, good morning everybody. Let's get going, it's 11 o'clock. So our guest this week is Helen Steers from Pantheon International, and so she'll be telling us all about that private equity fund, which will be interesting. There wasn't much news yesterday, but this morning it's all sort of come at once. We've got sort of a three-way merger potentially between GCP infrastructure, GCP asset-backed income and RM infrastructure income, and another three-way merger between Nippon Active Value, Atlantis Japan Growth and Aberdeen Japan. So that makes for sort of something interesting to talk about. And then obviously I just wanted to mention HydrogenOne capital growth as well. So infrastructure merger first. So these are quite big funds already. Sticking them together creates a fund with, so just the two funds now originally, creates a fund of about 1.35 billion of assets, so it's really quite sensible size. And they're also talking to bolting in RM infrastructure income as well, which is much smaller than the other two, but it would still be a useful thing to do, I think. In terms of the share price and discounts charts for these funds, they actually look fairly similar. So basically, we've got a big discount that's opened up here on GCP. Really, that's all related to rising interest rates and the impact that's had. We've got a discount that's opened up on GCP asset-backed income. And two things going on there that we've got the same problem here, but we also had a big kind of loss provision during COVID that was gradually released back again. So in terms of, well, hang on, let's get this right. It didn't affect the NAV in that way, but that's the way that shareholders reflected it there. Actually, it did happen that way in RM infrastructure income. So they did actually cut the NAV and then put it back in again. So here it was shareholders going, well, this is what might happen, and actually it all turned out okay. And in this case, it actually did cut the NAV and then they rebuilt it again. Obviously, the share price overreacted. You can see there, and then it just seems to be overreacting again now. So what you've got there is three funds doing similar-ish things, but all on big discounts. And these discounts are really quite significant, as you can see there. So GCP asset-backed income on 38 discount is quite enormous, and that's pushed them onto very high yields. So all of them over 9%. And that's obviously knocked all of their long-term shareholder returns for 6. But actually, when you look at the NAV returns, they're not too bad. You have got this weakness over 1 year, which is reflective of what's going on with rates, but it's still positive, and I find that a bit encouraging. So, in terms of what's going to happen, they are going to squeeze funds together, and then the first objective is to reduce the leverage overall. So GCP's got about 100 million quid of debt. GCP asset-backed's got about 40 million of debt. They're going to use cash flow from the portfolio to pay that down, the combined total down to about 50 million. And then they're going to use another 100 million of cash flow to return to shareholders. So this is a straightforward merger, but there is no cash exit opportunity. The cash exit opportunity, if you like, comes from this 100 million that they're going to return in form of buybacks and special dividends. And they've still got a buyback ongoing within GCP infrastructure, about 15 million quid, which is ticking away. So the investment policy is going to be tweaked as well. This is something that they've been thinking about for a while, because it's the same policy that they had when they launched, and the market's moved on quite a bit. So the big problem really has been that the government's been less keen to use private finance in the old kind of PFI type structures. So availability-based revenues, which was one of the sort of key things before, aren't really available. And they've had to adapt the portfolio to reflect that. And the new thing that's coming in, well, they are going to expose to some property risk now that they didn't have before. And they're also got a sustainability clause in here as well. And that reflects the manager's belief that if you're lending to companies that don't have a sustainability objective, then you are actually creating an opportunity for something to go wrong because of that failure to meet the sustainability criteria. So there we go. So as I say, the rationales are to cut the leverage overall, and they should be able to do that because the asset-backed portfolio has quite a short duration compared to GCPs. So GCP would take quite a long time to get cash flowing back to the portfolio and use that to rejig the look and feel of it. But GABI's portfolio should mature much faster. And then the other thing is, I think they think that part of the selling that's created these big discounts is coming from wealth managers who are merging, and this is something that we've been banging on for a bit. These big wealth managers become more and more inflexible in what they can hold. We're now going to have a fund that's decisively like over £1 billion, and that should allow all of them to carry on holding this, which I think might help stem some of the selling pressure. The cost savings in here run at about 800 grand a year. That's, eliminating duplication in terms of overheads and things. That's all helpful. That's not a huge amount of money in the great scheme of things because it's quite a big fund, but nevertheless, it's all a big tick in the box. So this just to reinforce what I was saying about the relatively short duration of GABI's portfolio. So this is from its fact sheet, the most recent one, which is the end of March. So over 70% of the fund is with maturity of less than 5 years. And here's a bit sort of more granular detail on it. So the whole portfolio is about 440 million quid. There's still got some cash as well. Spread across 60 holdings. There's a bias towards sort of senior ranking debt, which is something that also that GCP infrastructure aspires to do too. Portfolio yield is quite similar to that of GCP infrastructure, so there's going to be no real problem there. There is some inflation stroke interest rate protection too, which is all helpful given the current environment. And there's a fairly big exposure to construction, which would be manageable within GCP because if you go back to where we were looking at the investment objective, that those limits were all about 75% of the portfolio, and the other 25 could have some construction exposure. So it would have been sort of doable, but I think going forward that'll be lower. And in terms of what it's investing in, though, it is a different mix. So social infrastructure, like supported housing and care homes and things, that is in GCP infrastructure's portfolio. Asset finance isn't. That'll be a new thing, and I'm not sure if it's going to be retained or not. We're going to have to wait and see with that. The energy infrastructure thing obviously is quite a big chunk of GCP infrastructure's portfolio, and I guess that will just fold straight in. But the property stuff, which is the biggest chunk of the asset-backed portfolio, is not really a feature in GCP infrastructure. And so I think they'll be thinking about to what extent they want to retain that. Obviously, changing the remit will allow them to do it, but we're going to have to wait and see what the manager says about that. So the combination is the same as we've been talking about the last few weeks with all of these different mergers. So based on formula asset values, you just knock the two together. They're going to do it. They're going to revalue both of them at the end of September. And what that should take care of is any of the sort of problem loans within the asset-backed income portfolio that GCP infrastructure shareholders might be worried about. So at the 31st of March, asset-backed income had exposure 4.4% portfolio to problematic loans, and they're listed there. The co-living thing's been going on for a while. They had this great idea to back with co-living properties, which are sort of like a cross between student accommodation and affordable housing. That company was pricing those, didn't work out, and they've been sort of working through that portfolio ever since. The multi-use community facility stuff, they are sorting out. The larger one of those, there's two assets there. The larger one of those assets, I think they're almost ready to say this is no longer a problem. The social housing stuff, we've seen, this is not home REIT type social housing, but this is more of a sort of Civitas triple point type sort of thing. They've lent some money to houses that are rented to a registered provider that's in trouble with the regulator. and it's not paying its rent at the moment. But as we know with these things, if you just reassign the leases to somebody else, then the underlying tenants stay put and the income turns to flow again. So I think that gets sorted out. And the football finance thing is a something of a weird and wonderful thing. They were basically lending money to teams in Spain and Italy, secured against their broadcast rights. Something's gone wrong locally there that has caused a technical default with the loan. I don't think they're going to lose money on it though. We're going to have to wait and see. But say all of that chunk of problematic stuff will be revalued at the end of September, and that's the value that will be used in the combination. So I don't think infrastructure investors should be too worried about the impact of that. One of the new things is they're going to introduce a continuation vote. So there wasn't one before. It's not for a while. It's not until 2028, but nevertheless, I think that's a welcome addition. And then they're going to be every 4 years after that. The management team is basically the one that's been working on infrastructure for a while. Obviously, one of the main problems with asset-backed income was that it's lost its management team. So David Connell and Joanne Fisk, who came on the show a while ago, they left. And replacing them, I think they've recruited within the Gravis team, but I think it makes it's easier for them to talk the two funds together rather than trying to maintain two separate ones. And they think they can get all of it done by the end of 2023, which sounds ambitious, but I think might be doable. Definitely, their various advisors and things are incentivized to get on with it, make sure it actually has happened. There's an awful lot of costs here. Way too much in my view, but I'm not sure what you can do about it. Gravis is contributing £1 million because it's the manager of the two funds. But the GCP infrastructure's costs are still going to be £1.4 million, and GABI's costs are still going to be £1.2 million. So we're talking about £3.6 million in total in fees for this, between brokers and lawyers and things. As I say, I just find that a bit of a stretch, but there we go. Fortunately, because these are big funds, it's not huge in the scheme of things, but there we go. They are going to cut the management fee. So basically, there's a new tier structure, and we said what 1.35 billion of assets. So it'll just kick in with that. So if it grows beyond that, then there's a benefit. But it is on the cusp. And then the other one, RM infrastructure income. GCP was such an obvious partner for this that it did make sense that when they said we're looking, we're talking to people, we think we can't go on our own. We're in this strategic review, we're not quite sure what's going to happen yet. It was the obvious name in the frame. They do say they're talking to somebody else, so that there's no guarantee it's going to happen. And they're also saying that if they do combine with GCP infrastructure, it won't be a straightforward merger of the two funds. They will do is carve out the SIBA assets, are the COVID loans. And that was a chunk of its portfolio that are in runoff now, that have been quite lucrative for it. So that bit of the portfolio would stay behind. And I think that would provide cash for a cash exit for those people who want it out. And everybody else would roll into GCP infrastructure. That's the way I think it might work, but we'll have to wait and see. So I wouldn't be averse to them doing that as well, and just create sort of one big super fund in the sector. Now, the Japan one. So we talked about the combination of Nippon Active Value and Aberdeen Japan the other day. Atlantis Japan Growth. It was sort of darling for a while and actually performed quite well. As a chap called Ed Murney used to run it. Unfortunately, he died a few years ago. It's got a new manager. It hasn't performed well recently because obviously it's focused on growth, and we know that growth hasn't really been in vogue. And it's small cap too, and that hasn't been in vogue either. So that suffered a bit, and it is a bit too small. And so if it's looking for a merger partner, I guess Nippon Active Value jumped out again, because it's been the best performing one in the sector, and you can see that from the chart here. And also it's one of the few that's trading around asset value. So it's a straightforward merger again. All the mergers we've been talking about beforehand were all these Section 110 schemes. We talked about the mechanics of that before. This is exactly the same thing. It's just because it's a Guernsey company, it's called Section 391. And it's all, again, knocking together based on asset value and asset value. Here, there is a cash exit opportunity, and it's quite reasonable. So 25% of the fund at 2% discount to full asset value. I have to wait and see how many people go for that. I'm not sure. Just don't know about that one. And only one director's moving across. There's no news on the other one, on the GCP ones, about directors and what's going to happen there. But we'll have to wait and see when they publish the documents. And when you knock all three funds together, because this merger was announced a while ago, it is still progressing, then you are going to get sort of quite a decent size. And within that small cap market, I don't know what the limit is in terms of what's practical. I think we're not yet there in terms of like it being too unwieldy, but we have to keep an eye on that, I think. The Japan growth people are giving up a decent yield, and that might be one reason why some people tip the cash exit box. But the big thing they get is much lower ongoing charges, and I think that would be a good reason to go. And obviously much better performance, hopefully, if that carries on going. Again, Rising Sun is going to pick up the cost of this. So 800 grand they're putting in to cover the expenses. And then you also get the low ongoing charges ratio again. So tick, 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 all makes sense, and I would back that. They think they can get everything done before December. Actually, before when they were planning to hold their December AGM for Atlantis, Japan. And they've also got over 51% of shareholders, or 51% of shares on side. So it does look like a done deal. Whether they can get everything done at the same time, I don't know. It is cheaper, and this goes for the other one too. It would be cheaper to do everything at the same time in terms of these quite, remember the very expensive fees that we're talking about here. So we'll just have to wait and see if that can be done. Lastly, for me, I know I'm banging on a bit, but HydrogenOne. When we published a note, I'm not going to take all the credit for it, but we were banging on about the opportunity in the hydrogen sector and how cheap this was and how ridiculous it was that it was trading at such a big discount. And we published our note, and the price did go up, and it's eased back again since, and you can see it is ticking back up again now, and hopefully that is going to be sustained. What you can see is the NAV going up, and that I think is what's encouraging this. They made a quarterly NAV announcement this week. It's not a big jump in the NAV, but actually that's masked because the underlying portfolio is doing quite well. But they from a responsibility kind of point of view, they've done a good thing in terms of they've pushed up the discount rate in terms of what they're valuing these assets at. So that's now 13.7%. It's really quite cautious. Understandable, because these are risky assets. There are 10 private investments, some cash, but the key to it really is that where these things were quite embryonic when they first made the investments in them, a lot of them were anyway, we're now getting quite big jumps in revenue generation. So I know it's a small base, but 170% increase in revenue is a good thing. 8 out of 10 companies now revenue generating. Again, it all seems to be moving in the right direction. So if you want to know more about it, one of the things that we put out in the weekly estate, or be on this week's weekly too, is a blogger's guide to hydrogen on the website. And then when it puts out its interim results, which I think it will be in a couple of months' time, we'll write another note and follow up on that, because there has been some positive developments within the portfolio that are worth looking into in more detail. So that's enough from me. There's a good question there up on the screen there saying, which of the 2 Gravis funds would you buy at this stage? The asset backs on 38, infrastructure's on 30. I don't think, whatever they do with their asset values, I cannot imagine that there's that big a hit to the asset backed income NAV. So the obvious one to be would be to buy asset backed income at this price. And then hope that the whole thing re-rates post the merger, which I hope it would do. So that's enough for me, as I said.